So hello guys, I hope you are all fine. So I want to welcome you to this class. I hope you can see the board. So I'm going with something that you can see. So today we're going to talk about risk and return. So risk and return will be our topic. So risk and return will be our topic, and we shall be very fast. I hope the screen is not the board is clear. So hopefully, so I don't have any idea about the board, and I hope you can see the board. So today is on 28. So today date is 28. Mwezi wa sita. So I was saying risk and return. So topic. Risk and return. So topic. Now, so let us introduce what is a risk and what is a return, even before we go forward. Now, the word risk means that it is the word risk refer to probability of occurrence of a loss. So when we have a probability of occurrence of a loss, so we can call it a risk. Risk. Let me put the logo to. So it is as important for everyone too. We are saying that risk refers to the possibility. So refers to the possibility of generating a loss in the future. So the possibility of generating a loss in the future, we call it a risk. Or we can also say it refers to the probability or likelihood of occurrence of a loss. Now, when we have that possibility that a loss, there will be a loss, then we can say that that one is a risk. So those are the two definitions which we can confidently use in any situation. So in any situation, so probability of occurrence of a loss or a situation where we have a likelihood of occurrence of that loss. Now, we can also say possibility of occurrence of a negative deviation from expected results. So when we have a negative occurrence or a negative deviation from what we expected, then we can also call it a risk, because it is not in accordance to what we expected. So possibility of occurrence of a negative deviation from expected results. Now, risk has three elements. The word risk has three elements. The risk has three elements. So number one, we can talk about is occurrence of a negative event. Occurrence of a negative event. That is number one. Occurrence of a negative event. Number B, another element of a risk, possibility of occurrence. There is the possibility or likelihood. Possibility or likelihood of occurrence of events. So apart from it being negative, then there is likelihood of that event to occur. And then the last one, there is a loss. So there is a consequences or damages or losses caused by the event, So those are the three elements that we can talk about. Now, type of risk. Let's talk about type of risk. Type of risk. So we have two type of risk. We have financial risk. And business risk. Financial risk. Number B, we have business risk. We start with the first one. We start with the business risk kwa sababu ndio kuna mambo mingi. So we start with the business risk. Now, when we talk about business risk, this refers to the event which might hinder business or company or an investor for achieving their investment objectives. So let's define it here. Business risk. Business risk. You can say these are risk or events which hinders. So which hinders? The company or an investor. The company or an investor from achieving their investment goals. Their investment goals. Hapo. So tunasema these are the risk or the events which hinders the company or an investor from achieving their investment objectives or goals. Their investment objectives or goals. So investment goals, or you can also add objectives, which are the same. They can mean the same thing. So business risks are also called total risk because business risks are also called total risk because business risk are also called total risk because it contains both systematic and unsystematic risk, because it contains both systematic and unsystematic risk. risk because they contain systematic and unsystematic risk. We start with the first one, systematic. So they are called total risk because they contain the element of systematic and unsystematic risk. Let us have the systematic risk. So we start with systematic risk. And when we talk about systematic risk, these are risks which are beyond the control of the management. So these are risks which are beyond the control of the management, are beyond the control, which are beyond the control of management, meaning the management cannot control it because it is within the economy. So they cannot control it. A good example is interest rate. Now, when the interest rate is too high, then the management cannot borrow more money from institutions because it is expensive. So they cannot control that interest rate. They cannot reduce the interest rate in the market. So in that case, that kind of a risk which is associated with the borrowing, with that kind of a huge interest rate, we call them systematic risk. So which is below the control of management, and you can add, and it affects the whole industry. So it affects the whole industry at large. I.e., we can talk about interest rate. Interest rates when management want to borrow, we can also talk about COVID-19. So COVID-19 was beyond any organization. So the risk that was associated with COVID-19, the closure of the business and so on, the management could not control it because it was beyond the control of the management. So the government was in control. So that one was beyond it. So in that case, we can also call it systematic risk. Now, other items apart from COVID-19, imejaka kwa sababu that one is one of the common that we experienced the other day. We also talk about energy crisis as another example. Energy crisis. Now, when the cost of petroleum increases, now it increases in every place within the country. The management cannot go to the petrol station and tell them to reduce the price. So it is beyond their control. And then we can also add what? Insecurities. For example, the one that we had the other day, Mandamano. So there was that crisis which was beyond the control of the companies. And also it was beyond the control of the government. So that is, we can call it insecurities. And insecurities. So, but this one, it was beyond the control of the management, but it was a right for the people to go to the street. Anyway, but it's a form that one is beyond because in the process there was insecurity and so on, and therefore in that situation, then it is not beyond our control or beyond of the control of the companies. So the company has had to shut down their process within the day in order to avoid any risk which might come with such kind of situations. Anyway, we can continue and say systematic. Okay, before we go, let us add another point. Systematic risk cannot be reduced or eliminated. Cannot be reduced or eliminated. Through through diversification. So that is correct. So we are saying that systematic risk, they cannot be reduced or eliminated through diversification. Whether you invest in many assets, if the risk is there, it will affect all the business, and therefore it cannot be reduced or eliminated. Kama ni COVID-19 ina affect biashara, unapata ina affect biashara, ina affect biashara hiyo ingine, ina affect hiyo ingine. So there is no way you can diversify when we are talking about systematic risk. I think that one is fine. Up to that point, I think we are okay. So they cannot be able to do diversification of assets. So assets are do diversification of assets. Assets or portfolios. We can also talk about portfolios. So when we are having more assets, collection of assets to do or to invest, then that collection is what we call the diversification. So systematic risk cannot be reduced or eliminated through portfolio management. Anyway, we continue. So that is about systematic risk. So it is also called, another name you can find it. It is also called non-diversification. Non-diversification. It is called non-diversification risk. It is called non-diversification risk. That is another name. That is another name of systematic risk. So non-diversification, meaning you cannot diversify it. And then it's measured using a beta coefficient. It is measured using beta coefficient. So it is measured using beta coefficient. That one is all about systematic. Let's go to the other one. Let's go to non-systematic or unsystematic. We call it unsystematic. So unsystematic. Now, unsystematic risks, those are risks which are within the control of the management. So unsystematic risk. So we can write and say, so unsystematic, sometimes we appear as it and unsystematic, it is the same thing. So refers to the risk which is caused by the factor within the control of the management, which is caused by the factors within the control of the management. So it refers to the risk which is caused by the factors within the control of management. So these are risks which are caused by the factors within the control of the management. Within the control of management. Okay, and then we can continue and say, i.e. wrong investment. Now, when a company has, or when management has various investments to invest in, now it is within their control to pick the best investment to invest in. Through what? So through engaging expertise and so on. And therefore, if, for example, they fail to engage expertise, they might end up picking the wrong investment. Now, the risk, that kind of a risk is controllable, or it can be eliminated through it can be made through engaging expertise or through engaging in more investments. So if one fails, another one can boost it. So wrong investment. So when we make a wrong investment, then we have another investment somewhere that can boost it. Then in that case, the loss of this investment can be absorbed by the other investment. And therefore, we can say wrong investment is a good example of unsystematic risk. So this risk, so we can say this risk can be eliminated or reduced. Can be eliminated okay, sorry. Okay, I was saying that this risk can be eliminated or reduced through diversification of assets. Through diversification of assets. So this risk can be reduced or eliminated through diversification of assets. So it's also called diversified risk. It is also called diversifiable risk. The other one was called non-diversification risk or non-diversifiable. You can also use the word diversifiable risk. And then it is measured using standard deviation. It is measured using standard deviation. Now remember, the difference between standard deviation and a beta coefficient is standard deviation is a measure of risk. Standard deviation is a measure of risk. So when we're talking about risk, when we are measuring risk, then we shall measure the risk using standard deviation. Now, but we have another item which we call it beta coefficient. Let me check for you. So, but when we talk about beta coefficient, it means it measures volatility of change of something. And that something is what we call, let me see. Will I find it? Go to just a minute. So computation of beta. Do I have it? Anyway, we continue. I shall inform you, but that is in advance. But it measures the volatility of a security in most cases. The change. Let me. No, no. We continue. I will inform you later as we continue. Okay, I shall inform you later as we move on. So we continue. So tulikuwa tumefika wapi? So kwa standard deviation we have said is a measure of risk. Now let us continue. Let us talk about financial risk. Okay, before we talk about financial risk, diagram representation. Diagram representation. Diagram representation. So diagram representation nitaifanyia hapa hivi. So our diagram representation inakaa hivi. So we have something inakaa hivi. So an example can be told to explain systematic risk and a systematic risk using a diagram. So we have beta and standard deviation. So nimeweka standard deviation inakaa hivyo. We have beta standard deviation. Then hapo you have number of assets. Number of assets. Then you have something inaenda hivi. So sijui kama inaonekana on your side. Hapo. Let us explain it now. Now from this point, so we have systematic risk. Now from this point, up to this point, there. This one we call it systematic risk. So from that point to that point, ama tufanye hivi ndio ikuwe rahisi. Let us do this ndio ikuwe rahisi. Now, from this point to this point, hapo, we call it systematic risk. Systematic risk. Then from this point, this one now kutoka hapa inafaa ikuwe straight. Now from this point here, we call it unsystematic risk. So we call it unsystematic risk. So hapo itaonekana we call it unsystematic. This one, unsystematic risk. So we call it unsystematic risk. Now, if you can see our table there, you can easily conclude and say that when the number of assets increases, is increased, then the risk associated with what? The risk associated with systematic risk is reduced. Now, from our table, now assume let us increase the number of assets. Now, when we increase the number of assets in this form, in that form, now, to answer number one, when the number of assets increases, then systematic risk can be reduced through diversification. So can be reduced through diversification. So you can see as we increase our assets, the risk reduces. As we keep on increasing our assets, the risk reduces until it becomes constant. So we cannot reduce the risk completely. So the risk cannot be reduced completely. So we shall reach at a particular point. Let us call it point K, this one. So at point K, has the minimum risk, which cannot be reduced beyond that level, through diversification. Now, beyond that level, now we call it unsystematic risk. Now, unsystematic risk. And then we can say, okay, that one is number 2. So the first one we call it systematic risk. Number 2, unsystematic risk. And we say when the number of assets is increased, then the unsystematic risk, the risk will remain the same. Will remain the same because the risk is beyond the control of the management, is beyond control of the control of management, is beyond the control of the management. It's beyond the control of the management. So in that case, we can conclude and say that from our diagram, that when we increase the number of assets or when we increase the portfolio, then it is clear that the risk reduces when we are talking about systematic. But for unsystematic, when we tend to increase the number of assets, the risk tend to remain the same. Anyway, let us move on because of time. We shall have a meeting today also, remember, from 9. We shall have it from 9. I want to do more on this topic. I want to finish this topic today. So it may be shifted to exactly 9. So it will be 1 hour class, so 9 to 10. Today we shall be having tutachoka leo sana, but we need to choke, but at least we finish so that we can be doing revision on what we have been doing. It is important. And the video will be also available. So in case you need the video, or in case you missed the video, you ask for it. Now, financial risk. Talk about financial risk now. Financial risk. Now, mostly, this is the risk associated with borrowing. So this is the risk which are associated with borrowing. Now, when you borrow, you might end up defaulting. So the risk of defaulting can also be called financial risk. But let us define it and say this refers to the risk which arises due to inability of a firm to settle its short-term maturity obligation. So wakishindwa kulipa madeni. So this risk arises where the firm is unable to pay their debt in time. So we can write and say these are the risk. These are the risk which arises due to inability due to inability of a firm to settle their short-term maturity obligation or debt. So that one is fine. So these are the risks which arises due to inability of a firm to settle their short-term maturity obligation or their debts. Now, wakati kampuni imeshindwa kulipa madeni zake, then that kind of a risk is called financial risk. Kwa sababu wakishindwa kulipa madeni, there is a risk that their asset will be taken by the lenders. So in that case, that risk is what we call the risk of the asset being taken over. That's what we call the financial risk. Now, we can also continue and say, I hope my screen inaonekana. I hope inaonekana. We can continue and say the risk of a single. So the risk of a single asset. So this one is not portfolio. Remember, it is not portfolio. Not portfolio. Remember, this one is not portfolio. Can be measured using using A variance, B standard deviation. That one is very, very fine. That one is very, 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 very fine. Now, formulas. Let us talk about some formulas. So how to get expected return? Now, expected return. So expected return. Now, expected return is denoted by that one. So expected return is given by summation of return of A, we multiply with probability of A, plus return of B, multiply with probability of B, up to return of N. So this one depends on the number of returns. So return of N, we multiply with probability of N. So that one. So summation, we're talking about summation. So that's the general formula for expected return. So ER, so where our ER is expected return. RA is security return. IE, remember, always is in percentage. So remember, it is always in percentage. Now, if your return is not in percentage, you need to convert it to percentage. So your return. So RA, now mention RA. So we have RA, RB, up to RN. Up to RN. So all those. And then we have probe A. We have probe B. And we have up to probe N, which is the probabilities of securities. Probabilities of securities. So this one is security return. So and then this one is the probabilities of the securities. So all these are the securities, and then all these are the probabilities. I think hapo inaonekana poa. haina mambo. Sawa sawa. So once we can calculate expected return, we also need to know how to calculate variance. So you need how to know how to calculate variance. So how to calculate variance. So after we know how to calculate expected return, another thing we need to know is how to calculate variance. Now variance, in capital, variance will be given by. Now our variance to tumeanza ni ya kwanza. This one is number 1, expected return. This one is number 2, variance. Now variance will be equal to, you can start with if you start with expected return, everything you start with expected return. For example, we have A minus return of A. No, sorry, expected return, the one that we have, minus return of A. Remember, it's supposed to be summation. So summation of expected return minus the return. Now everything we square, we multiply with, so return of A, of A. And then everything we multiply with probability of A, so squared, plus now expected return minus return of B squared, we multiply with our probability of B. Let me zongesha mbele hapo ndio tuone. Then plus, remember we are now up to, that depends on the number of securities. So expected return minus return of N squared, then you multiply with probability of N. Now, when you find this one, you shall get our probability. When you find that one, you shall get our probability. Now, next one, number 3. Once we can get the variance, we can get standard deviation. Standard deviation. And we can say it's the square root of variance. So we can go good and say it is the square root, the square root of variance, the square root of variance. Now we can do a question from a past paper. What else do we need? Let us talk about before we do a question from a past paper, let us talk about covariance and correlation of coefficient. Let us talk about covariance and also correlation of coefficient. Now, covariance. So we can write something here. So we write subtopic. We have a subtopic here. Relationship between risk and return of assets. Now we can say, so when an asset, is exposed to more risk, there is likelihood that the asset will generate more return, and vice versa. and vice. So that one is one of the relationships that we know. That one is the common one. That when an asset is exposed to more risk, then we might conclude and say that it might have more return. Now, we can say the efficiency of portfolio, the efficiency of portfolio is not only measured by number of assets, but also influenced by the degree of relationship, between the security, security. Now, so the relationship is measured in the following manner. The relationship is measured in the following manner. A. So A, we have covariance, and then the other one we have a correlation of coefficient. So covariance of the return Number B, we have correlation of coefficients. Correlation of coefficient. We start with the first one, covariance. Sawa, let us start with covariance. Okay. So start with the covariance. Now, when we talk about covariance, you can say it measures the level of variation between returns. It measures the level of variation between returns. So covariance, we can say it measures so let me shift my stuff on the other side. I think when I shift it, I hope the quality of the image does not is not affected within the process. But anyway, so we're talking about covariance. Covariance of the return. Now, covariance of the return, and you can say that it is a measure. It is a measure of the level of variation. It's a measure of the level of variation between returns of the security. between return of the securities, between returns of the securities. Now it is computed in the following manner. In the following manner. Now, in this case, this is where we only have two assets. Now, for example, we have covariance of asset A and B. So covariance of asset A and B. Now we can say. Now we have, for example, when we have probability number A, let us first, in the case of probabilities. So in the case of probabilities, now we can say covariance of A and B will be equal to expected return of A minus return of A, then expected return, for example, of B minus the return of B, then you multiply with probability, then you multiply with probability, and then number B, in case of no probabilities, in case you don't have probabilities, now we can say covariance of A and B will be equal to expected return of A minus return of A. Remember it's summation. So the word summation, Mr. How. Then you multiply with expected return of B minus the return of B. Then you multiply with, we divide it with, no, we don't have probability. We divide it with the number of items or the number of observation. So we divide it with the number of observation, sorry. We divide it with the number of observation or sample size. So N, the sample size. So that is number one, covariance. Number B, correlation of coefficient. Correlation of coefficient. Now, when you talk about correlation of coefficient, now this one is the measure of degree of relationship between assets. So measure the degree or the magnitude. So it is a measure. It is a measure of the magnitude. The magnitude or the degree or the strength of the relationships between securities or assets So measure the relationship between the or the returns of the securities. So or to make even in a sound it sound very reasonable between the returns of the securities or assets, between the returns of the securities or assets. So I want us to give you the formulas. So the formula to Andika in this side. So I'm doing away with this part. And then so So before you give the formula, we have these tables. So let me move this one to the other side. Hopefully bado mambo tu iko sawa, inaonekana. So now diagram illustration. Diagram illustration. Diagram illustration. That is the first one. A, perfectly. Perfectly. Perfectly negative relation. So perfectly negative correlation. More together a positive. Rather than a positive. Perfectly positive. And you can say for perfectly positive correlation, you can say there is a strong relationship. There is a strong relationship. So there's a strong relationship between returns of the securities. Between the return of the securities, i.e., an increase in return, an increase in return. So an increase in return of security A, for example, of security A, will lead to an increase in return of security B. Now, that is positive correlation. Na inakaa, let me see kama kule kuna tunachora hapa, and it is here. Let us do it here. So we have this one. So we have security A. So this one tunaweza ita security A, naandika hivyo. Security A. This one is security B. Then our line is straight. And then our dots if we were to plot, then they are concentrated along the line. And therefore the correlation of this one of security A and B is always 1. You need to remember that for perfect positive correlation, then the correlation equals to 1. So the correlation is always equal to 1. So that is number 1. Number B, we have perfectly negative correlation. And you can say there is a weak relationship. There is a weak relationship. So there is a weak relationship between return of security A and return of security B. The return of security B are forming the portfolio. forming the portfolio. Now, and then you can say an increase. So i.e., an increase in return, an increase in return of security A will cause a reduction. Will cause a reduction in return of security B. You can draw here. Let us draw it here. So we have security B, and then we have security A. Then it is on that side. Now when we draw, now our item will be inversely related, and then they'll be concentrated along that line in that case. And then you can say our coefficient of A and B will always equal to -1. Will always be equal to -1. So you need to remember that the correlation of coefficient of the when you talk about perfectly a negative correlation, then it will always be equal to -1. Then the last one, number C, no correlation. No correlation. So that's another one. And then you can see there is no relationship between securities forming the portfolio. So there is no relationship between the security forming the portfolio, and then we can draw it here. A small one too. So we have security A, and then security B. So kama inaonekana sawa sawa. Now this one we cannot even if we try to plot it, they are scattered. Now we don't know the relationship between the security A and B. Therefore, we can conclude and say it is impossible to state the relationship between securities. Between securities. Now this one, the coefficient of A and B is always equal to 0. Is always equal to 0. Now I think now we can try and do some question. Let me see if there is something else we can see. Now the formula for correlation of coefficients. So we need the formula for correlation of coefficients. Do we write it there? There now. Now correlation of A and B will be equal to covariance of A and B. We divide it with the standard deviation of A. We multiply the standard deviation of B. So covariance of A and B. We multiply the standard deviation of A and B. So leo mpaka tumalize hii topic. Hii nayo lazima tumalize. Hii nayo Motua, we need to complete it. We are about to complete it. So we are just about to complete this topic. Now let me introduce the last item. then we shall be good. So let's talk about portfolio risk and return. Portfolio risk and return. So when I talk about portfolio risk and return, portfolio risk and return. So narudi on my starting side. So we are going back to our starting point there. So let's talk about portfolio. So portfolio theory. Portfolio theory, and we can say that our portfolio refers to collection. So it refers to the collection of investment opportunities. It refers to the collection of investment opportunities or securities or securities aim at minimizing the risk. Aim at minimizing the risk. That is all about the portfolio. When you talk about a portfolio, then we means that it refers to the collection of assets. It refers to collection of assets. Collection of assets in order to minimize risk. Now, let us give the formula for portfolio. We need to give the formula for portfolio. Now, let us write it here. Expected return of portfolio. Now we can call it expected return of P. So naita P hapo is equals to, now this one is tofauti. It will be equal now, to security. So security expected, it will be equal to expected return of security A times the weight of A. Now this one is the weight. Then it's supposed to be summation. Summation. So expected return of A multiplied with weight of A plus expected return of B multiplied with weight of B plus up to the point where nafika mwisho. So depending on the number of our expected return. So expected return of N multiplied with the weight of N. So that is all about it. So that is all about it. 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 Then pengine. I will continue. that one is all about it. Now tunataka tuendelee. Nataka tuendelee kidogo. Haya. So that is about expected portfolio return. Now we need to determine actual portfolio risk. That is actual portfolio risk. So actual portfolio risk, and this is the formula. Now the formula will be equal to what? Now the weight of A. Now in this case, now let me tell you, in this case now we can only have two assets. We can only have two assets. Now we cannot do more than one because our formula, this one, will not allow. So in an exam, we shall only be given two kind of assets. So they cannot exceed two assets. So if they give you more than two, then we can also solve it using this formula. So we have weight of A squared, standard deviation of A squared plus weight of B squared, multiplied with standard deviation of B squared plus 2 times weight of A times weight of B, then covariance of A and B. Then covariance of A and B. Or you can opt for this one. Weight of A squared, that division of A squared, plus weight of B, that division of B squared, plus 2 times weight of A times weight of B. Then you multiply with correlation of coefficient of A and B times third division of A times third division of B. Then everything square root. So that's another way. That's another way you can do it. Now, I think with that one we can do some questions. So I think we are only remaining with one formula, which in the state hapa chini yake. It is the formula for getting expected portfolio risk. So expected portfolio risk. So how am I call it weighted? So weighted or expected portfolio risk. Portfolio risk. Now this one you can say it is the weight of A times standard deviation of A plus weight of B times standard deviation of B. Then ya mwisho kabisa, it is the percentage of diversification.
The symbol for weighted expected portfolio is?
Weighted expected portfolio is equals to the weight of A multiplied with the standard deviation of A. Let me write it again.
Yeah, I mean, you see, when we were given a symbol like for the actual portfolio risk,
Actual.
is a deviation P. What's the symbol for the weighted? Because that we are given is the formula.
Sija kuget, let me karibu. Okay, hebu niambie, hebu rudia.
I'm saying the symbol for
The
weighted
symbol. Oh, the
expected.
symbol. The symbol of the weighted we can use which kind of a symbol? Mostly the symbol inakwanga unaandika tu hivi. Let me show you. Unaandika jina weighted. Unaandika tu jina weighted, then with the standard deviation portfolio. So weighted side. Remember this one is a form of. Remember this weighted. It is a standard deviation. Now it is just the weighted but standard deviation of the portfolio. So that tunasema ni weight of A, the standard deviation of A plus weight of B, standard deviation of B. Most inaandikanga hivi in most cases. So sijaona any other way. Siko sawa. Then ya mwisho,
Yes.
percentage of diversification of risk diversification. Now the percentage of risk diversification is equals to the weighted standard deviation minus actual. Now actual ndio hii, this one hapa. So actual standard deviation, then divide it with weighted, then everything will multiply by 100. So it is represented in percentage. It is represented in percentage. Now you can do a question. Let's go to a past paper. Start with the last sitting. Now, I think tukishafanya maswali kama ine tutakuwa tumemaliza the syllabus. Now open our past paper. Let us open our past paper. Tuanze na last sitting. Tunataka leo tufanye something constructive kabisa. So tuanze na last sitting. Now nataka ni shift. So umeshaandika. Let me shift. Iko sawa. Nataka nianzie huku nikienda kule. So last sitting is that one was last sitting. So I hope umefungua past paper. So last sitting, the first question was question number AP 2022 question 1C. April 2022 question 1C. So can you see it? So April 2022 question 1C. April 2022. So wanasema the following information relates to two potential investments, namely investment M and K. So those are our investment, and we have each investment has their security. Now required, number one, compute the expected return for each investment. Now let's start with expected return of investment K. So start with M, and we said our formula was summation. Now we are supposed to take summation of the securities, you multiply with probabilities. Now we start with number one, 20 times 0.3 plus 8 times 0.4 plus minus 4 times 4 times 0.3. So we shall get the expected return of M. So what will be the expected return for M in that case? So haraka Hiyo ni ngapi? 20 times 0.3 plus 8 times 0.4 plus minus 4 times 0.3. That is 8%. Nimesema ni ngapi? Nimesema ni 8%. 8%. Go to the next one. Expected return of K. Now we find it. Hii itakuwa ngapi? Itakuwa kwani inafanana? Oh, tofauti ni probabilities. 20 times 0.2. 8 times 0.6 plus minus 4 times 0.2. They are all the same. Now, expected return of K is also 8%. So that is part A. That's all about part A. Part B.
No, they are not the same.
A and B.
They are not the same.
They are not the same. Na mimi napata zangu. Okay, then 20 times 0.3. 8 times 0.4.
3.2.
And then minus 4 times 0.3. Oh, that is 13.2. This one is 13.2.
Yes.
13.2%. Okay. Then part B, they are talking about standard deviation of M. Remember what did you say about standard deviation? From our formula pale nyuma utaangalia sasa kuandika juu ya time. Now for us to get standard deviation, we are supposed to get summation of the probability. Sorry, the summation of expected minus the return itself. Then we multiply with, so we square it. Then we add probability. Now let us do it here. So let me do it in this way format. Ilikuwa rahisi to save time of A. We start with M. Na tuanze na ya kwanza. So expected return ni ngapi? Ndio hii hapa. 13.2. 13.2 we minus our first return ni ngapi? Ndio hii hapa ni 20. Then we square it. Then we multiply with probability which was 0.03. Then we are supposed to add. So naekea hapa chini. We are supposed to add also the same 13.2 we minus 8 squared. We multiply with our probability. We're also supposed to add the third one, which is minus. So minus 4 squared. The multiply is 0.3. So when we add everything together, we shall get variance. So when we add everything together, we shall get variance. So tukishapata variance now, we can get the standard deviation, which is the square root of that number. So tuanze, so 13.2 minus 20. Then we square that figure, then we multiply with probability of 0.3, which is 13.872. Then 13.2 minus 8 squared times 0.4, which is 10.816. Then 13.4 minus 4 squared times 0.3. This is equal to 90.828. So we add 10.816. We add 13.872. That is equal to 115 variance 0.516. Remember, it is expressed in percentage. So this one is 115.516 square root. So it will be 10.7478%. You remember hivyo. So that's how you do it for that part. So tunaenda the other side. Tufanye our friend here. Our friend ni K. Now lazima tuanze na the first one. Tuliona ni 8. So to minus 20. Then probability. Then you multiply with probability. Also 8 minus nangapi na 8 squared. And then multiply na probability. Huwa atakuwa kwanza ni 0. And then wa mwisho ni 8 minus 4 squared times 0.2. Then to add, we shall get variance. Then the square root of variance, the figure for that division. So tuanze nayo. So huku inaonekana sawa sawa. So 8 minus 20 squared times 0.2. 28.8. And then 8 minus 8 is 0. 0 squared is 0 times 6 is 0. Then 8 minus 4 squared times 0.2 kweli? 0.2. 28.8. 28.8. So we add the two, 28.8, which is 57 variance 0.6%. Then we get upper 57.6, which will be equal to 7.59%. So that's how you're supposed to calculate the division of both item. Number next, compute the portfolio return. So portfolio return, remember, expected portfolio return is equals to return. Now, in this case, we have two: return of K, weight of K, plus return of M, multiplied with weight of M. So let us try and compute it. Now, in this case, we have been told that 30% of the wealth is investment M. So tuko na M, tuanze na huyu M. So M return yake ni ngapi? Ndio huyu 13 M. So M ni 30, so tuweke hapa, tuanze na M K. So tuanze na M, which is the yake ya kwanza ya M. If unaiona hapa juu 13.2. We multiply with the rate ni ngapi? 30%, which is the weight is 0.3. And then tukuje kwa 8, which is, the rate is 0.7. Now we shall get the expected portfolio return. So 13.2 times 0.3 plus 8 times 0.7, which is 9.56%. So that is the portfolio. Hadi hapo tuko sawa? Now, let us compute the other items. Wajasema in case wangekuwa wameuliza. Ya kwanza ni wajasema to compute the covariance. Let us compute covariance of A and B, and we said now this one is covariance of M and K. So these are others. Wajasema, but it is good you know them. So for us to calculate covariance of M and K, we shall get the return, expected return, shall be equal to expected summation of expected return of K minus the security summation, and then also expected return of you get it together na M minus the security, sorry. So expected return of M minus the return of M. Now kumbuka summation, so ziko mingi, kumbuka ziko na probability. And then expected return of K, you multiply with the security of K. And then everything, you're supposed to multiply with what? Yes. According to this question, can we get the covariance of that one and that one? You're supposed to multiply with probability. Now, according to this question, is it possible to do covariance? Is it possible to do covariance? Because I can see we have three different type of probabilities. Is it possible?
Yes.
I think it is possible. How do we gonna do it?
We will pick the probability of the first one of the
We shall multiply the probability
put the
and the second one to get the joint probability.
Yeah.
Okay, and that one can also work so that we can have a joint probability here. And that is the only possible way, because I don't see any other way with that question. So let us start. Let us start with the first one. Now tuanze na hii, tuanze na ya M, then tuelekee M ilikuwa ni 13.2 minus 20, and then tuende kwa K. Ya K ilikuwa 8 minus 20. Then over with the joint probability. So what is the joint probability? So 0.3 minus times 0.3 times 0.2, which is 0.06. Aya, twende wa pili. Au hadi hapo inaonekana, sitaki niende chini sana. So I think hadi hapo itaonekana. Twende kwa pili. So 13.2 minus, so wa pili ni 8. And then 8 minus 8. Then we multiply with the joint probability, which is 0.6 times 0.6 times 0.4, which is 0.24. And then the last one, 13.2 minus 4. So minus 4 mineka hivyo. And then 8 minus 4. Then multiply with the joint probability, which is 0.3 times 0.2, which is 0.06. Then you can find the total covariance. So covariance of A and B. And remember, when you add this joint probability, must be equal to 1. Hebu confirm kama inakuja 1. Kama inakuja 1, then we cannot use it. If you add the joint probability, must be equal to 1. Inakuja 1 kweli? I think one. I think one. Do you think that one is the best way?
I think no.
Maybe we think about it, sivyo?
Yes.
So we should think about it. You know, kama you have to probability or covariance. We should think about it, sivyo?
Yes.
Tutajadiliana later. So because this probability must be equal to 1, it's not equal to 1, then that one we can conclude and say that that one for now is not favorable. So let's go to the next sitting, which is December 2023, question number 2B. So December 2023, question number 2B. Now wanasema, so in that case wameuliza, so lazima tufanye. So wameuliza number 1, standard deviation. But remember, for us to get standard deviation is at first, we shall get first expected return. We start with A of security A. Let's start with the expected return of security A, because we need that one. So which is 27 times 0.4 plus 21 times 0.5 and then 18 times 0.1. 18 times 0.1. I think so now this question is possible because we only have one probability, which is both for the two items. So 27 times 0.4, 21 times 0.5, 18 times 0.1. Confirm if it is 23.1%. Then also need expected return of B. So confirm kama hiyo ndio the correct answer, which is 36 times 0.4, 33 times 0.5, 33 times 0.5, then 31.5 times 0.1. So what would be the answer? So 36 times 0.4 plus 33 times 0.5 plus 31.5 times 0.1, which is 34.05%. Now to the other side. And on the other side, tukisonga, what does tusonge on the other side? Apple. So that is, we are supposed to calculate standard deviation. Now, we start with the standard deviation of A. So we are supposed to take expected return minus the normal return, and then we square it, then multiply with probability. So tuanze na kwanza, ya kwanza ni 23.1 minus 27, then squared, then we multiply with our probability of 0.4. Then wa pili 323.1 minus 21 squared times 0.5, 0.5, then 23.1 minus 18 squared, then we multiply with 0.1, so that we can get variance. So we get variance, then baadaye standard deviation of A maybe go to the square root of that variance. So 23.1 minus 27 squared times 0.4, which is 6.084. 23.1 minus 21 squared times 0.5, which is equal to 2.205. Then 23.1 minus 18 squared times 0.1, which is 2.601. So we add everything together. So 6.08 plus 2.2, 2.205, 2.601, which is 10.89%. Now 10.89. So square root of that answer, which is 3.3%. We go to the one for B. Now for B, we have it here is that 4.05. That 4.05 minus the first one was 36. Then we square it. We multiply with a probability of 0.4. The second one is that 4.05 minus 33 squared multiplied with 0.5. Then we have that 4.05 minus 31.5 squared, we multiply with 0.1, so that you can get our variance. Now, square root of B will be the square root of variance. So 34.05 minus 36 squared times 0.4, then equal to 1.521. Then that 4.05 minus 33 squared times 0.5, which is 0.55125. Then 34.05 minus 31.5 squared times 0.1, which is 0.65025. So we add 1.521 plus 0.55 125 plus 0.65 025, 2.7225. Naileta hapa 2.7225 square root itakuwa ni 1.65%. So tumemaliza part A. So part A required us to compute standard deviation of A and B. Number 2, covariance of A and B. So covariance of A and B. So remember our formula for covariance. So covariance, we are supposed to take the expected return, which is 23.1, we minus 27, and then we multiply with the year Chini, that is 4.05, we minus 36. Then we multiply with our probability, which is 0.4. So hiyo ni ya kwanza 0.4. Then tuende kwa pili. Juu kama inaonekana, inaonekana hopefully. Sawa inaonekana. Tuende kwa pili. So it is 23.1 minus 21, and then 34.05 minus 33. Then multiply with the probability of 0.5. Then ya mwisho 23.1 minus 18 minus 34.05 minus that 1.5. 31.5, then you multiply with probability of 0.1. Now the summation shall get covariance of A and B. Sijui kama hapo inaonekana kama nimeenda iko sawa. Let us find it. Let us find it. Now the first one, 23.1 minus 27. Tunasema 23.1 minus 27. Then you multiply with 34.05 minus 36. Then you multiply with probability of 0.4. This one is around 0.7, 0.702. And then next one, 23.1 minus 21. Multiply with 34.05 minus 33. Then with the probability of 0.5. Is equal to 1.1025. 23.1 minus 18. So 23.1 minus 18. 34.05 minus 31.5 times 0.1, which is 1.3. 1.3005. So we add 0.7 plus 72 plus 1.1025, 1.3005. So our covariance is 3.105. 3.105. Now they require us to compute what? They require us to compute covariance. And then number 3, nafanyia hapa number 3. They also wanted to ask for a correlation of coefficient of A and B. Now, coefficient is equal to covariance of A and B, then standard deviation of A times standard deviation of B. So what is our covariance? Our covariance is here 3.2105. We multiply the standard deviation of A, ndio hii 3.3. We multiply with 1.65. So how much is that? How much is that? I think that one will be ngapi hiyo? Okay, we are in the finishing line. We are in the finishing line. Na tujafanya sari yote ya portfolio. So tujafanya sari yote ya portfolio. Mapana ngapi? So 3.105 divided by 3.3 times 1.65. That one is equal to 0.57. 0.57. This one you can comment. This one is it? Is it strong correlation, weak, or which part? So that one is so it's it is between 0 to 5. So 0 to 5. Okay, you have to explain baadaye anyway. That I shall explain later. Let's go to that one is over. That question is over. So they wanted us to compute that one, which is 0.5. I want to do the one for portfolio. Ndio tukuwa tumemaliza hii kitu kabisa. So sitting nyingine inafuata chini yake August 2023. Do we have a question on that? So that's sitting hawakuleta. So back at April 2023. Now April 2023, we have a question. Yes. Question 3C. So April 2023 question 3C ndio tutakuwa I think swali yetu ya mwisho. So April 2023 question 3C. So April 2022, question number 3C. So April 2022, question number 3C. So let us try that question. Wanasema question 3C. That Magic Group portfolio comprises of Magic A with expected return. Now amesha kutupatia hapa expected return. Now this one tulishapewa. Now we know expected return tumepatiwa of 10%. Using for A 10%. But if you have division of A as third division of A 20%. Then pia tumepatiwa expected return of B. So you have to Magic B as 16%. Then third deviation is 40%. Is 40. So correlation of coefficient of A and B. Correlation of coefficient of A and B is 0.4. 0.4. So weight of A is 30%, which is B is 70%, which is 0.7. Now required, number one, expected return of the portfolio. So expected return of portfolio. Now this one is equals to the expected return of the normal security multiplied with the weight. So expected return of the normal security we have 10, we multiply with the weight, which is 0.3. I expected return up to 16, we multiply with 0.7. So we shall get the expected return of the portfolio in that form. So 10 times 0.3 plus 16 times 0.7, which is 14.2%. Next third division of portfolio. Now third division of portfolio is equals to 2. Remember the formula, the big formula. So weight of A squared, third division of A squared, weight of B squared, times third division of B squared, plus 2 times weight of A times weight of B. Now this one, because we have correlation of coefficient, now we shall use this one. Correlation of coefficient of A and B, multiply with the third division of A times third division of B. So tuanze, weight of A is 0.3 squared times third division of A 20 squared. Yeah, B 0.7 squared. Standard deviation, third division of B is 40 squared plus 2 times 0.3 times 0.7 times. So we need to multiply it with the correlation of coefficient. So itakuwa mrefu kidogo. Let me nifute. So 2 times weight of A times weight of B times correlation of coefficient is 0.4. Then remember to multiply with the third division of A, which is 20, the third division of B, which is 40. Now we shall get to the standard deviation of the portfolio as the third division of portfolio will be what? So it will be equal to 0.3 squared plus 20 squared plus, 0.7 squared times 20 squared plus 0.7 squared times 40 squared plus 2 times 0.3 times 0.7 times 0.4 times 20 times 40. This one will be equal to square root of 954.4. So what will be the standard deviation of the portfolio? Square root of that answer, which is 30.89%. So Martin, I think that one is the end of the class. So we shall take any other kind of a problem when we shall have time. So I think do we need to have a mail or tuiweke kesho peke yake sasa tumemaliza topic mzima ya risk and return?
We can make it tomorrow for because now hata siwezi shikanisha.
Kesho. Ongeza sauti kwa sababu ya time, si ndio? So kwa sababu ya time na time imeenda sana. But the good thing tumemaliza topic kabisa.
Then does it?
But kuna kitu
Oh, this is the cost of capital.
Capital gain ama?
Sorry?
Unasema sija kusikia?
Is it this the whole thing for the capital cost of capital topic?
Hapana, hii ni topic nyingine. Hii ni topic nyingine. Tuko na cost of capital. Kwa cost of capital tulisema tunasoma, ndio ni topic kivyake. Kwa cost of capital tulisema tunasoma cost of capital. And then tuseme hiyo work, MCC, leverage na point of indifference. Hiyo tulimaliza cost of capital. Iliisha.
Na so, amortization?
Amortization hiyo iko under time value of money. Tutafanya time value of money later. Sasa hii risk and return nitakutumia cost outline actually. Uko nayo ama uko nayo?
Nini?
Cost outline?
No, I don't have.
Au naenda kutumia. Na kuna kitu nataka nikuoneshe. Ya hii topic. Unajua kuna kitu sijafanya. Kuna hii formula. Acha nikuandikie formula. Sijui kama kuna any question in our past paper. Acha tuimalizie tu mara moja, si ndio? Acha tu tuimalizie once and for all. Sitaki kurudi hapa tena. Ni formula tu, it's a formula. And then nitakwambia swali wameleta ni ya kitambo. It's a very long time ago walileta. Very long time ago. But I want to let me just show you the formula in case walete tena warudie from kitambo. Then we shall have at least something to write. Now we have this formula to find the percentage of securities. So notice kwa hizo masomo tunafanya, notice that the securities ziko in percentage. So notice.
Yes.
So what if wakulete swali securities haziko in percentage? Now you need to convert the securities to percentage. Now we have these formulas. I want to give it to you. So unachukua, for example, this one is the first one. Unachukua forecasted. Forecasted market price. Una minus buying price, buying market price. Then una divide kila kitu na buying market price. Then you multiply by 100. So utapata ikiwa in percentage. Si ni kweli hapo? Then you have another one. Another way you can get the percentage of securities. Percentage of securities. Unachukua P1 minus PO. Ndakwambia what it means. We add dividend or gain or any gain or any amount we have received in form of dividends or capital gain, whichever. Then divided by PO. So remember P1 price at the end. Price at the end. PO price at the beginning. So hiyo nilikuwa nataka kuonesha. I think ni hiyo tu. Hakuna kitu kingine. Now, hebu fungueni kwa una multiply na 100. Umepotea kidogo. Sijui mbona unapotea.
Yeah. No.
Una multiply na 100, si iko sawa?
Yeah.
Now, unakumbuka ile nilikutumia revision kit?
Yes.
So I want you to open that revision kit. Nikuoneshe something. I want you to go to page. I want you to go to which page? Kidogo. Go to page 39. Go to page 39. Umefika page 39?
Yes.
Now we have question 1. So question 1 anasema using a well-labeled diagram differentiate between systematic and asystematic risk. That one was December 2014. Sio iko sawa? Question B, wanakuambia calculate expected